Do you remember the last time Jeff was on the show? Guess.
Like exactly when it
No,
was?
just like around when.
Oh, we're going to put it on camera.
Oh.
We're going to put it on camera.
You gonna talk about it?
Yeah, we'll talk
When do you think he was on? Take a guess.
I don't know.
I know you don't know. Guess.
Wait, why would I know?
All right, I'll tell you. I guess it.
What do you want from me?
It was so long ago.
Oh, all right, fine. You want me to guess?
It was
December.
yeah. 2022.
How about? Wait, what?
Yeah.
Really?
Yeah,
we
dude.
haven't seen you since
It's
then?
been a year and a half. It doesn't feel like a year and a half, does it?
No.
Time. It's too fast.
Yeah.
Wow.
It's not a constant though.
No, it's not. So the title was "The Game Has Changed," and
Back
that was the bottom.
Yeah, it's right
That
there.
was the bottom.
Do you feel like time is speeding up as you get older?
You kidding me?
I mean, I
Like
feel like
time warp.
the months are flying by.
It's not even close.
I don't
just
even
did-
notice the change anymore.
I just took my son on my youngest on the college tours, right down south. I'm like, whoa, like you kidding me?
See 11th grade?
Yeah.
Okay.
Like, come on.
Your last kid?
Yeah.
My first kid just got into school.
Nice.
So we did that last year.
Yeah.
She's graduating in a month. I don't know how.
It's ridiculous.
Yeah. I agree.
So my kids are 5 and 7, and seeing Josh's daughter go to school makes me feel really weird because when I started working with Josh, she was 6.
Yeah. She was a baby.
Like what the
Right.
And so it's like freaking me out a little bit.
Yep.
Well, the thing that somebody said to me that's like the most true thing I've ever heard is that the days are long, but the years are short.
Yeah. Right. Yeah.
So when they're little and you're like on soccer fields and then baseball fields and it feels like it's forever.
Right. Yeah.
But then you realize, oh my God, another year just went by.
Totally. That's
Yeah.
totally true.
Dude, Jeff, if you need anything, just hear the noise. Hear the ice
Right,
in the,
exactly.
In the cooler. And that's me. For
That's
cocktails. The worst looking barmaid you ever had.
You gotta get the engineers involved. That way, it's like a complete
Shit show.
Yeah, exactly.
Just derailed.
Exactly.
Ladies first, Nicole, would like a.
I'm good, thank
Pretty
you. No,
mixed, enjoying
I'm
read?
great. I'm good. Maybe in a little bit.
We might just have you guys.
We just had a lunch. We had Santoli showed.
Oh, really?
He's off to.
Santoli's great.
He's great. He's off to.
I'll let you.
He's one of the best.
The best at what he does.
I'd say he's the best.
Yeah,
Jeff, no laptop today?
the full. I mean, I can put this up.
Do you want to do that?
I mean, if it,
Sure.
yeah, if it
Whatever
hides,
you're comfortable with.
if it hides my sweat
so
marks.
we'll talk about this, but that was the top in rates, no?
When? Just recently?
Yeah.
Yeah. I mean, I'm in that camp. The chart doesn't tell you that that's officially there, but I think when you've got the,
Chart on?
I think you're trying
Jeff.
to make it look like something. Yeah, I know. I'm with
We have
you,
more
but the charts
important
are still there.
We have more important things to worry about. Is
Like what?
Peloton going to zero?
No.
It's $2 stock. Are you sure?
No, I'm not sure. It'll get bought.
I don't know anything.
I
about
just
the
don't know who buys
valuation. Yeah. I know
Okay.
nothing
Peloton
about it.
CEO Barry McCarthy steps down amidst the company's restructuring, laying off 15% of the global workforce, which is 400 employees.
And he came in hot,
Hold
right?
on. So the stock spiked immediately following the announcement because for most companies, layoffs are good. Not this one.
Yeah.
Stock price then dropped. This is the 5th round of layoffs for Peloton since 2021, when it had 8,600 staffers. Yeah. This was a $261. Was this $161 or $261 stock? I forgot. What was the high?
I'm looking right now.
It couldn't have been a more perfect storm for that
Yeah.
stock, right?
In both directions.
Stay at home. Everybody's getting fat. Like, you
The
know.
market cap's down 98%.
But what was the peak share price? Because I'm a dollars guy.
I know. Josh doesn't do percent. He's
Divide it by 86.
he's very traditional. Yeah.
26.
The top
Here we go.
was 167 and it's now under $3. Is that bad?
Dude, that is as bad. And that was a meme stock for a minute, right? Or was it just
Oh,
a
yeah.
Oh
COVID
yeah,
no,
stock?
definitely.
Oh yeah. So too much debt. Yeah, not really a ton. Who would buy this though? Like, is there any value here?
Nobody. And there's not even a short squeeze. Like the shorts are going to cover at zero or never cover.
But so the last time I looked, which was a year ago, maybe more, they had hundreds of millions of dollars in recurring subscription revenue. Like there's something there.
Because the machines, if you're losing money on the machines just to get recurring revenue,
Yeah.
you could do that and eventually catch up. But if the sales of the machines keeps falling, then your installed base that you're modeling those recurring revenues for is shrinking too.
No, you know what?
So it
Maybe
doesn't, you can't get
maybe
there.
private equity comes, buys it for pennies on the dollar, and cleans it
I
up.
don't know what the debt is.
More
It's not a
importantly,
con.
what happens to my Peloton? Is it just a regular bike now?
I haven't rode my Peloton
I haven't
in a year.
But you know what? It holds 8 jackets.
Exactly.
That's what I figured out.
That's
It holds
exactly right.
8 jackets.
That's exactly right.
So it's worth. Speaking of working out, did you see these yet? What'd you think? Pretty nice,
Not
right?
bad.
Not bad. Nicole, get a shot of the
That
shirt.
shirt is going to be blowing off my back as I'm flying through the air.
Feel the material. That's pure
Oh,
velvet.
That's nice.
This is like the
Dry fit.
dry fit.
Wicking
So-
velvet.
Maybe this is an overshare, but the dry fit material has this combustibility chemical with my skin where I
Do you
put it
see
on.
what's going on
I
here?
put it on and I smell.
That's 3. That's
What?
3. That's 3.
What?
Michael is stockpiling excuses in advance for this.
I'm running. I'm just saying.
for
I'm
this
going to
5K.
smell. That's all.
You're gonna come
He
bust
came in today. He's like, guys,
Where is this 5K?
Central Park,
All
JP
right.
Morgan corporate challenge.
Oh, yeah. All right.
He goes, guys, I was on the phone and I stepped off the curb and I hurt my ankle.
No.
Last week,
No,
he's saying
hold on.
he
I
has shin splints.
crumbled. I took a step off the sidewalk and my ankle went like that and I almost hit my knee. That's how
How
much
many
I
weeks
fell.
of training are you going to miss because of
I'll
that?
be good. I'll run tomorrow.
All right. But now also we have an issue with the shirts.
I have no issue with the shirt.
You just said it's combustible.
with my.
You just said if you run
It
in
makes-
this race with us, you're going to be on fire.
smelling. I will smell. That's okay.
That's
I don't
fine. You'll
mind.
be nowhere near me.
I don't mind.
Okay.
What's your shoe of preference? What are you running?
Ooh, I don't
We'll
even
have to
have
see
running
what his
shoes.
injury
I
situation
use my.
is.
I run in my on clouds. Although, so Josh and I were just in Los Angeles, and we were walking from.
Did you call him Sir Josh?
I don't know. We were walking up to Sunset Boulevard, and we're walking up the hill, and he fell to his knees.
I didn't fall to my knees.
I'm like, Nicole,
I took a break.
He sat down.
Right. You know I didn't fall,
but how?
right?
But you can't walk, but you can run. I don't get it.
No, I can walk and run,
That
but I
was
took a
lot of
break.
walking.
It was a lot of walking. You walked us into the Hollywood Hills.
We have photo evidence.
What, of me sitting? Is that the worst thing that ever happened? Come on.
So you're not a runner.
No, Josh is a runner.
Are you a runner, Josh?
I used to be.
Really?
No, at this point, it's pure spite. I'm only running.
I hate runner.
At this point, I'm only running and training because Michael said I can't finish a 5K.
Well, I didn't know. I assumed. I thought it was a safe assumption.
Was it 3.21?
Dude, it's 3.5 miles.
Is it that long?
Pretty much
3.1.
3.1.
But this is a 3.5.
3.5.
Are you
So
running
this
it?
is slightly longer than a 5K.
Stop at 3.1. It's not
Have you
gonna
done
get-
this before?
So these are metric miles?
I've done it a lot, yeah.
The JP Morgan one.
Yeah.
Are you
He's a
running
real
it?
It's not
runner.
bad.
He ran the marathon like 3 hours 40 minutes. No,
But
2 hours 40 minutes.
I guess
What'd you run it in?
Eric,
crazy.
what I'm saying is like the people that are running in this race are not marathoners. It's just like regular people completing a 5K. It's like no big deal.
But the problem is it's hilly in Central Park.
Are you kidding
Always
me?
hot.
Oh, that's not great for Michael's shin splints, the
And
We
hills.
just did
The
LA.
average pace for the first is 10,000 people jammed into the street. So like your first mile is walking because you can't.
I line up in the back.
Nice
You know,
pace.
David Kelly's a marathoner.
I don't want to be in anyone's way.
Yeah, just take your time.
Who is?
David
Oh,
Kelly.
Dr. David Kelly?
He when he was here, we were talking about he's run marathons.
Yeah. Well, I don't. But you're right about that point. Everyone tries to get up to the front,
Yeah.
and then you can't really explode out of the gates in something like this.
No, you just take your time. Don't try to like zigzag around. But my point is, it's hillier and hotter than people remember.
It's hillier and hotter. I think though that we want to not lose sight of the fact that it's for charity, right? Like
JP Morgan?
yeah, isn't that for charity?
I don't know.
Yeah, I'm pretty sure it
It's
is.
got to be, right?
I mean, but they keep their name on it pretty much.
It's the corporate challenge, but
Right.
they raise money for.
JP Morgan?
I think it
They
raises
do a
money
great job
for
at
Central Park.
making it well known who's
Yeah, yeah.
sponsoring it.
John, we good?
Just about.
I think they raise money for the park itself. So Apple reports tonight. What's your whisper number? I'm just kidding. I'm just kidding. You know how we do? You know how on CNBC, like we do a recurring segment. Does the market need Apple to rally? You know, like you've heard that before.
I haven't heard that one. I'm
No, you're
sorry.
stealing my thunder.
Oh, why?
Okay, I plan on talking about this later.
All right, we'll go there. We'll go there later. Is that me?
It's Ben Carlson.
Take it.
Very confident in my assertions.
And on that.
Ben,
What's up?
you're in the studio with Jeff DeGraaf and Josh. We're about to start recording the Compounded Friends. What's on your mind? Thanks for calling
You
in.
called me.
Oh, I called
You
him.
called me.
Damn, that's embarrassing.
Ben, Mike called you because he missed you while he was in California this week.
All right, love you. I'll call you after.
Love you is a lot.
Very confident in my assertions.
Shout out to Ben.
What kind of show are we doing here?
Uh,
One more second. And on that note, let's turn on Do Not Disturb. on
good
the
idea.
comms.
Good idea. Good idea.
Cooler's in your way.
True.
Oh, you're fine. All right.
The you called me was pretty good. True story. He does have me there. I actually called him.
All right, you looking good now?
Yeah, I think so.
All right. 3 claps coming in.
I knew something.
And friends, episode 140.
Today's show is brought to you by Global X. Since 2008, Global X ETFs has been committed to empowering investors with unexplored and intelligent solutions.
Global X specializes in ETFs that track emerging trends like the rise of artificial intelligence, as well as strategies aimed to generate high income potential.
Visit globalxetfs.com to explore a lineup of more than 90 ETFs, along with insights to help you navigate a dynamic investing landscape. That's globalxetfs.com. Episode 140. Ladies and gentlemen, you are now tuned in to the world's greatest financial / investment / lifestyle podcast. We were the best fans in the world last week. This week, Michael and I were in Los Angeles. Great turnout, great enthusiasm. We had so much fun meeting you guys. Thank you to everyone who got up, got in the car, came to see us in Los Angeles. That show, for those of you who missed it, is going to be on all channels shortly. But I want to just give a shout out to the fans who came. Today's show is going to be amazing. We are with technical greatness is the way I would phrase it. Our friend Jeff deGraaf is the chairman and head of technical research at Renaissance Macro Research, aka RenMac. Jeff did time at Merrill Lynch, Lehman Brothers, ISI Group. He is a member of the Institutional Investors Hall of Fame. He's a private pilot. He's a CMT and a CFA charter holder. Jeff deGraaf, welcome back to the Compound
Gentlemen,
Friends.
thank you. It's been a while.
We didn't realize
Was it
how
something
long-
I said?
No. We didn't realize how long it's been. We're so
fine.
happy that you're here.
So what's the date today?
Today, we're taping this on Thursday, May 2nd at approximately 3:08 in the afternoon. And I guess it's been 16 months since you were
It's
here?
almost 16.
Okay.
Wow.
Should we go back to what Jeff told us last December?
What did you tell us last December?
Well, it was 2 Decembers ago.
It was
Two Decembers
excuse
ago.
me,
Yeah.
2 Decembers ago.
What was the name of it? What would we call it?
The change is coming?
Yes, or something changes here, or something
Yeah.
like that. Yeah. Something catchy.
Yeah.
Yeah,
But
catchy.
the game has changed.
The game has changed.
Yes.
There we go. Right.
But you, so I know you're not like, you don't do like extended victory laps, but there were a lot of key things about that period of time that were changing. And some people picked up on them, some people didn't.
Yeah,
But in the charts, it was pretty clear that stocks were behaving differently.
definitely.
So what do you remember about that moment, and what do you think you'll be able to use going forward as a reference point for your own, just like, oh, here's how the market works?
My edification.
Yeah.
Yeah. So it's almost Cinco de Mayo, so I brought you guys some margaritas.
We appreciate
Cheers.
we appreciate
All right,
that.
Cheers. Happy Cinco de Mayo.
I'm going to
'cause
hold off on my first sip until we get at least 45 minutes in.
That's fine.
Okay.
No problem.
All right.
I'm already 3 in.
Okay, good.
So a couple of things were going on then. I think the big one, and this has been really a part of our process for 25 plus years, which was this relentless improvement in the credit markets. It just was continuing to get better and better and better, corporate spreads, et cetera. And that's just not something that you'd expect to see if we're going into recession, which is what everybody was predicting. And look, I mean, the curve's inverted. There are a lot of signposts there that say, hey, you know, historically when this happens, then that happens.
Yeah.
But if you looked at the real-time indications, what the blood pressure of the market actually was, it's like, this patient's not dying. This patient is actually stable at a minimum and maybe actually flourishing underneath the surface.
So we had Neil Dutta on recently, your partner at RenMac.
Yeah.
And similarly, he became known for being one of the few voices in macro saying,
Right.
I know everyone, I know the consensus is now recession is a foregone conclusion, but I don't see it that way. And he ended up being right as well.
Yep.
What's interesting to me is he arrived at the same conclusion that you did, but he's looking at the economy and you're looking at market behavior.
Right.
Okay.
And I think that's an important part of our process at RenMac, which is we don't get in a room and say, I'm bullish, so therefore you be bullish, or you're bullish, therefore I'm going to be bullish. We come to our own conclusions.
Yeah.
And I think it's important because if you don't, then you're going to lose good people, right? I mean, you have to have your own sort of intellectual horsepower and curiosity and independence. And, so when we come together and I'd say we're on the same page, boy, I'd say it's probably 70% of the time.
Right.
But it's for different reasons. And we can play off each other. And then we can also challenge each other too. And so I think it's really helpful to say, hey, Neil, what's going on with the truckers? Oh, this is something to do with labor unions. Okay, that's fine. Like the charts look bad, but that's a idiosyncratic problem, right? And so, we play around that. And not everybody does that. And I think it becomes a real problem. One, who do you follow? Because everybody sooner or later is going to be wrong. So do I really want to be stuck going down the drain with somebody else?
It's so funny that you say that. Obviously, Michael and I aren't selling research, but we do a show on YouTube that's been running for like 5 years now, and we often disagree, but we work together. It's possible to have a workplace environment where two people arrive at different opinions for entirely legitimate reasons.
Yep.
And eventually one of them will be right, or maybe both will be wrong. And that's like, okay.
Yeah.
We don't have to have a situation where you work here, I work here, I have seniority, therefore you have to accept what I'm saying.
Right.
So I think that that's the way things should be. But I also understand, especially on Wall Street, where reputations and egos, I understand why there's a lot of research shops where it's not that way.
Right.
So,
well, and look, in our business, the data is changing daily, right? I mean, Neil gets a data point every single day. If he's looking globally, it's almost every single hour, right? We get market feedback every single day, and so you're gonna have to be malleable, and your views are gonna change through time as the data changes and the markets tell you how you should be thinking about things. So being very rigid in those outlooks is it's a recipe for disaster. So you really need to be fluid in your thinking and something that I've always thought about, which is, okay, here's where I think we are. Now, what are the likely paths to where we're going, right? And so what are those signposts? What are those things that are going to tell me that I'm on the right path or I'm on the wrong path? And if I'm on the wrong path, then what is that path? How do I identify that path and what should I be looking for there? And that's really, it's a daily process. I mean, I write daily. Our clients get what's known as the deGraaf daily. They see our daily commentary. And it is a royal pain in the ass. There's no doubt about it. Sorry about clients out there that get it. But the reality is I do it as much for myself as I do it for our clients because it forces me to look at the markets every single day and figure out what's going on, or at least put the chart on the pile that says, I got to figure that out. Like, I don't know what's happening here.
Okay.
What should I be doing about that?
Do you think the market is noisier than it was when you started, just because you mentioned the data points that we get? There's so many more data points that literally technology wasn't able to capture probably when you started your career?
I think, there's an old story about a client who used to messenger car service, black car, the Financial Times to his office from JFK to get the head start, to get the information advantage, right? So he'd have a guy there at whatever it was, 4:30 in the morning, grabbing the paper.
And take the information highway
yeah,
to his office?
Right? Otherwise known as the Van Wyck, right to his office so we could read it early before the rest of the street. It's a good question. I mean, we don't find that there's more or less mean reversion. We don't find that there are more or less false trends or legitimate trends. The market's chemistry, as we view it, the way that we look at the world, has stayed relatively similar. Now, it's not exactly the same. I will say that things like breadth, and I think this is because of ETFs, breadth tends to pendulum. In other words, it'll be 100 or 100% of the financial stocks are up on the day or 100% are down because it just becomes a basket.
The way they're bought and sold now.
Yeah, it's just easier to do it that way.
Yeah.
Where back in my day at Lehman, it was never like that. If you want to create a basket, we could do it with 10 names.
I'm sure you could find things within the market that's very different, but I made a chart of the rolling 30-day change in the S&P 500 going back to the beginning of time. And just by that one metric, there's no difference between now and 100 years ago, just within the S&P 500 or whatever market you're using. It's an EKG.
Yeah.
I want to ask you if you think it's possible for a technician to have quote unquote conviction versus someone that's looking at macro or fundamentals. I'll tell you why I'm asking that question. You're looking at the charts every day.
Yeah.
You might believe something on a Monday that 2 weeks later, 2 following Mondays later, becomes completely invalidated by price. As a technician, you can't double down on what you thought 2 weeks ago. You have to say, this is what I thought, but this is what I think now. It's a discipline that inherently does not lend itself to the concept of conviction if you're truly focused on price, because prices change. Someone who follows the macro, they probably shouldn't have as much conviction as maybe they have, but they can say, no, this is a blip. My original opinion was still right. So like, what's the push and pull within your own mind when you're deciding whether or not you've changed your mind, or you decide, no, I still think I'm right? Because you kind of have to be somewhat malleable.
Yeah.
Not in your principles or how you look at things, but in your conclusions.
Well, I think the word you use is probably the most dangerous word on the street, which is conviction.
Yeah.
What conviction implies is that you know something that the rest of the market
And everyone else is wrong.
Right.
Yeah.
That's pretty dangerous in this business. Now, look, there are people that can make money doing that, but there are also plenty of people that lose a lot of money after they've made it that do it. We have an old saying, conviction kills and dogma is death. And, I think you have to be pragmatic. And when you're pragmatic, the idea is that, look, I believe that this trend is in place. I try to really disassociate myself with the narrative and the news flow. That's pretty hard to do, but I really try. I try to do that. And you have to rely on those tools. Now, for us, sentiment is important. For us, mean reversion indicators, long-term mean reversion indicators are important. And in the interim, the trend following indicators are important. So if I'm in a situation where I know, and I know we talked about China a little bit, China to me is very similar to the last time you had me on for the U.S. I think that we're in a game-changing environment.
We gave you a shout on Halftime Report
Thank
today.
you. I appreciate it.
You were on with Scott last night talking China or something?
Yeah, 2 days ago, I think.
2 days ago?
Yeah,
Okay.
yeah.
All right.
But the point of that, and I'll walk you through it, which is we know that the long-term alpha generation, just by owning the Shenzhen 300 or the ETF, whatever you want to look at, the long-term alpha generation is the worst it's ever been in the history of our data. You've never lost more money on a risk-adjusted basis.
Versus S&P.
MSCI World, right? The entire world.
All right.
So you've never lost more money with more volatility than you have as of basically the beginning of the year. So that to us starts to perk our antenna. Okay, this is so bad that maybe it's good, but that's the first set. The second is then, where is the sentiment? Usually the sentiment will follow the price, and particularly the risk-adjusted price. And we measure a lot of different things, but the ETF outflows were one that stood out to us, that people are just saying, why am I in China when I can own Nvidia or whatever the case may be?
Yeah.
So you've got that behavioral aspect that set itself up. And then we wait for price. We wait for price to confirm. And we made a tactical call back at the end of January that we thought those two the confluence of those two, sentiment and the alpha, was enough to say, look, let's play for a bounce. I think this is washed out.
And that was the bottom.
But yeah, and I think that, we thought it was at least a tactical bottom, right? And a tactical bottom to us is like, that's 20, 25% in a pretty short period of time. Like, you can play it and make money, and it's a pretty low risk way to do it. But what's happened is we never came back and retested. We actually stayed up there, and now we're starting to break out again, and we're starting to change these trends. And so from my standpoint or my seat, I look at it and say, look, the biggest sin I can commit as a technician and as a listener to the market is not believing it when it happens, right? So I've got these two preconditions that I know historically are pretty good, and now the market's telling me that it wants to go higher. And I might be wrong. There's no doubt I might be wrong. But if I'm wrong, I'm going to be wrong by that much.
How much is like K-Web up off that late January print?
I don't know. Probably 20-ish%.
It's a bona fide bull market. So you know what's so funny about what you're saying? So you're looking at this through the lens of price and technicals. Somebody that doesn't focus on that at all could have made the exact same bull case on Chinese equities in January, but for entirely different reasons.
Completely.
Somebody who focuses on the news flow would have said, hey, the authorities on Beijing seem to be saying a lot of things that are constructive about their own stock market. They threw out the head of their version of the SEC.
Yeah.
They enacted all sorts of like more friendly policies, and even what's his name made an appearance Jack Ma showed up at like in an interview or something.
Right.
So I mean, this guy was exiled probably where
Right.
Napoleon bought the farm.
Were his hands in front of him, or were they behind him still?
Dude, he was relaxed and he was
All
like,
right.
and he was like talking about Alibaba or something publicly. So somebody that focuses on news flow and not technicals could have said, I think these stocks are worth the risk here. They're in an 80% drawdown or whatever. Or now you could have somebody that's fundamental. They could say, oh, valuation wise, these are the cheapest stocks in the world, growth stocks. And they were. The Chinese internet companies were growing still, I think 20, 30%. And they were selling for multiples as if they would never grow again. Probably because the risk was existential.
Yeah.
Like, will these things get taken off the U.S. markets?
Well, and that was a term that I had heard a couple times, and it's always music to my ears, which is this market is uninvestable.
Uninvestable was the consensus
Yes,
on these
correct.
assets.
Perfect.
Okay, so when are you going to
Except
start?
for when it's Russia.
When are you going to start buying Russian assets? I was going to ask you, that was where I was going next. Okay, all right, but so anyway, I think that's really interesting that different people looking at the market with a different discipline could have all reached the same conclusion, and I mean that looks like one of the better global markets year to date right now.
Well, and that's a good point too, Josh, which is, is it easier to create a bull market in the lone bear market when all the other G7 are in bull markets? Or is it easier to create a bull market when everything else is in a bear market? Of course, you're going to, there's just some tailwind that you get there. And I think what could be interesting, it's not our call, but I'm thinking about it, which is, are we today in an asynchronous world, right? In other words, the Fed's trying to slow down the U.S. There seems to be some evidence that it's happening a bit. At the same time, you have China stimulating. Do we end up doing this that, in aggregate, it ends up being, 2.5%, 3% growth, but nobody's growing too hot, too fast. It's not collectively synchronized. And as we slow, then we start to stimulate. As they speed up or get too hot, they start to pull it back. We might be in
Is
this.
that how the world used to be before the great financial crisis? You had different central banks moving in opposite directions at all times, right?
Yeah, the 90s, before the 90s was really it. I mean, it came out that, modern portfolio theory, you started adding to particularly EM back in the 80s, early 90s. And about the time that was published, it stopped working.
Well, that's an interesting observation because for the last 10 years, it was all global central bank coordination. Everyone was doing the same thing.
Right.
Yeah.
Right.
And you have less currencies now also. The 80s and 90s, every country had its own currency.
Right.
Now there's like 4 that matter.
Right.
So it would be nice if we had an environment where if the S&P has a bear market, you can call your clients and say, all right, cool, but Brazil and Japan kind of bailed us out there. We just haven't had that in a really long time. It feels like.
I remember the back in the days in the early 90s where the big bearish narrative on the U.S. was you've got the second largest country in the world, which is Japan, in this massive bear market. And there's no end to it. How are we ever going to not be sucked into that vortex?
Yeah,
and we weren't, right? And so. Stranger things happen, I guess, is the way to think about it.
Not to belabor, we can move off this China thing in a minute, but I was telling you before we started that I bought China, and a few days later I said, I don't want to deal with this headache. So, the same thing, washed out in sentiment.
Reading proxies in
exactly.
in Chinese.
Just completely washed out, and the stocks did stop going down. And I said, you know what, I'm going to take a shot. And then a couple days later, I just said, I just don't feel like allocating my money here. I'd rather just put it somewhere else because there are so many things working over here, right?
Yeah, sure.
But there's a big difference between identifying a trend change and then putting the money there and sticking with it, like on the way up, and especially during the chop. It's hard.
It is hard. I think an important part. I started trading commodities probably 25 years ago. Best thing I ever did in terms of just creating the discipline. One, because there's a massive amount of leverage, so you can't mess around. 2, it really lends itself to technical analysis because there's no way I can know what's going on the Ivory Coast with cocoa at the same time I know what's going on with soybeans. I mean, it's impossible, right?
You have to obey price in that market,
right?
No matter
so
what.
With that, I knew at every point where I was going to get out or where I was going to get in. Right? No ifs, ands, or buts, no messing around. I just knew where it was going to be. And so it's not that I didn't have that emotional creep that comes in and says, oh, is this right? Should I be here? Should I not be here? But it just kept you disciplined and just said, look, if I'm wrong, fine, I'll be wrong at this level.
But you knew before the trade.
I knew before the trade.
Right.
Absolutely.
Federal Reserve FOMC was yesterday. Rates were left unchanged. Seemed like a pretty positive reaction. I felt like today, like people woke up and just said, you know what? Yeah, that's kind of cool. He didn't double down on hawkishness.
Yep.
He didn't seem nervous. He didn't intimate that we could have hikes on the table. These were some of the things that crept into market psychology during the course of April. I think April was the worst month we've had since September or something
Sounds
for
about
the
right.
S&P 500.
Probably. Yeah.
So a lot of like rollbacks of people's expectations for rate cuts in the second half of the year, and a lot of concern that the economy is slowing, but maybe it's stagflation because inflation is still with us, et cetera. So he kind of poured cold water on all of that, and the market was able to recover. Is that how you read it?
I do read it that way. I think the setup was important, though, and the setup to us was there was a narrative that developed partly because of what you're talking about, which was policy-wise, and partly because of what we've seen from AI and what we call the momentum narrative, right? So
Right.
You had momentum running in basically the 94th percentile, the spread between high momentum names and low momentum
What, coming
names.
into April?
As early as early March. It
Okay.
was in that. So we are unapologetic momentum players, trend followers.
Yep.
I mean, we will do it all day long until it gets to an extreme where it tells us that good chart is actually vulnerable because the momentum factor is so strong. Right?
So
In
you
other
want
words,
your momentum going more like this and less like that. Like
I
once
want
it starts to go.
Yeah, I want the spread between the best stocks and the worst stocks to be somewhere between the 20th and 80th percentile
Normal,
of historical
normal.
returns.
You want a
Right.
slope. You don't
Right.
want Empire State Building.
Correct,
Right.
right?
Okay.
And so once you get there, it's the one area that we found that we are going to say, hey, we're selling good charts. We don't want to be a part of this. And what you end up with from momentum extremes is usually a sentiment extreme, right? So price drives behavior. It's not the other way around. So when you get the strength, people become more bullish. They start making so-called irrational decisions, or at least, not well thought out decisions. And so you have this pocket of opportunity for disappointment. And I think that's exactly what the Fed did, and what we saw with the inflation numbers is it wasn't that those numbers were so bad. It was that the expectations were so high,
Yeah.
and it just didn't take as much to push you off into that, what we think is a consolidation/correction right now. Not the end of the world, but certainly it was a function of where the positioning was and the expectations of where things were going to be.
I think you're exactly right. It was really easy to make money in January, February, March. We had that narrative of the broadening, which was true at the time.
Yep.
You could, I think 10 out of 11 sectors were positive on the year. You were making money in things that didn't really work last year.
Yep.
But then also the stuff that worked last year was really working this year.
Right.
You had Supermicro and Arista Networks and this whole
Everything.
new crop of AI names leading.
Yep.
And it was just easy.
Yep.
And you woke up, you bought NASDAQ stocks. By the end of by the close, you were higher.
Yep.
And once it gets like that, I totally agree with you. It changes people's behavior. They bet bigger. They are bolder.
Yep.
The way they come into stocks. And more stocks start working because they start looking for what's the next Nvidia, what's the
Right.
next. All right. So we had that behavior. I think it got washed out in April. I don't know, though, on the internals if it really hit extreme levels. I mean more like when you talk to people, they don't seem as bullish as they seemed in February.
Definitely not.
Okay.
But I wouldn't say they are to the point where we can say with high conviction that this correction, if that's what you
Oh,
want to
no,
call it,
I
is over,
agree.
right?
Nobody's despondent.
Right.
Still buying stocks.
Right.
Just as
Okay.
one random anecdote. So this is a chart of Caterpillar,
Mhm.
right? Like the correction that we just happened was absolutely necessary.
Oh, look at that.
Right? Like this is, you look at this, you say this is a good thing. You need these corrections along the way. This is
Yeah.
what sets up the next leg higher.
Yeah.
If we do get one. I'm not specific
Yeah.
to Caterpillar, but just generally speaking.
So interestingly enough, the two areas that were reflective of the most momentum was tech, obviously, right? That's easy. But industrials was the second. Tech has corrected from the, call it 93rd, 94th percentile of momentum down to the 61st. So that's kind of done what you would hope it to do.
Yes.
It should get a little better, but not the end of the world. Industrials were in the 99th percentile, so higher than anything we'd ever seen.
Those are the best charts.
They're unbelievable.
Yeah.
But it's only corrected to the 94th percentile. So The point being, there's probably still more of that to work itself out. Now, that doesn't mean that it's bearish for the next year, but what it means is that the next 3 months, the next maybe 6 months, you're probably going to have underperformance. And that's why to us, the narrative is important, because once you get those momentum spikes, the narrative generally changes. People want to go back to whatever that was back in January, February. We want that, right? But the market doesn't give you that. The market will not be a bear market. It'll still be in a bull market or a bull phase, but it will pick up on something else. And that's why the China breakouts, that's why the copper breakouts, these things are so important to us, because we feel like the high probability trade is not bullish to bearish, but bullish to rotational into something else. And that's what we're still trying to sort through in the dark here. Where are those charts? Where are those potential leadership names? But that's our here. That's our top play.
One of the ways that we got a positive reaction post FOMC is that we still have no idea when the rate cutting cycle is going to start, if it's going to start this year or not. But they did say that they would slow the pace of reducing the balance sheet starting in June, which is something that maybe we don't focus on all the time, but shrinking that balance sheet is de facto pulling liquidity from the markets.
Yeah.
It's doing so in a fairly invisible way unless you work in a bank. You can't really see it. It's not posted in the newspaper. But
is the liquidity here in the room with us right now?
Yeah. But specifically, it was cited that that decision to do that was to ensure that money market funds don't experience the volatility and stress that they saw in September 2019.
Right.
So, which is when they started doing reverse repo out of nowhere, and people were like, wait, why are you doing that?
Right.
So I guess maybe that was like a little bit of an olive branch to the people that were hoping for a sooner cut. But all things considered, we still have high inflation prints, and we still have no idea when we're getting rate cuts. And the market is holding up fairly well in the face of that much uncertainty. And I'm actually a little bit surprised that the reaction wasn't worse.
From the markets.
Yeah, for stocks.
Yeah,
You don't sound like you are.
Yeah, look, I think we had 2 weeks ago, there's three things that we look for at a low. We look for what's called an external oversold condition, which I can talk about, an internal oversold condition, and then we look for a sentiment extreme, a sentiment spike.
We'll stop right there. What is the difference between those two things?
So an external oversold condition is you look at the S&P, it's a conglomerate of 500 different names, and that oscillator, we use our own oscillator, is oversold, and it says the market's oversold, right? So you could put that on, you could put it on corn, you could put it on copper, you could put it on cotton, it doesn't matter, it's just, what it is. An internal oversold condition is what's happening to the constituents within the market, right? So the first one doesn't care about what 3M's weight is versus Google versus anything else. The internal is individually how many names are oversold, right? And we do that on a percentage basis. So 54% of the S&P 500 made a 20-day low simultaneously back about 2 weeks ago. That's a good number. That's a number that says
that's a washout number.
The risk managers are tapping people on the shoulder, saying, "I don't care what you think about XYZ, take it down." Right? We don't want that much of it. We had 10% of the names trading above their own 20-day moving average, very short-term moving average. Both those are internal measures of being oversold.
90% were below.
So
that's a
were below.
washout.
Yeah. So we have an external oversold condition. We have an internal oversold condition. We start saying, okay, we're in the zone, right? This is the zip code. What we'd love to see, it doesn't always happen, so this is the challenge. What we'd love to see is spiking put-call ratios, something that shows that people are now
That's the sentiment part.
Positioning themselves differently, playing more or protecting more for the downside than the upside. We hadn't really seen that. Now, it's not that surprising because one, the correction lasted all of 3 weeks. So sentiment's a function of time and price. We're down about 5%.
Also, wasn't terribly severe.
Right. So, I sense that it's just going to kind of grind a little bit more and take it out. But we had a good oversold condition.
The problem is it really a correction if Amazon and Alphabet are making fresh all-time highs?
Yeah,
it's
I hear you.
You know what I mean?
Yeah.
It's like it's hard to really characterize it as a correction.
Yeah.
But
Jeff,
Jeff,
that's why we use those internal measures, right? Because
Right.
usually if it's above 50%, it's good enough, right?
As somebody who wants the market to go higher over time, I would much rather
Is that
see
you or me?
Me.
Okay.
Not you. As somebody who wants to see that, I would much rather see this sideways corrective action as opposed to the market just continuing to go higher and higher and higher, because that sets up for instability.
Yeah. Yeah, I would agree. If we have a consolidation, That takes us in through the end of May. I think that's good news. And by the way, if you look at presidential election years, the lows seasonally in election years tend to come right around Memorial Day. So there's
Is that true?
So there's notion of sell in May and go away. I for one, I don't know where that ever came from because it's not really true. You should be selling in mid-July.
It does rhyme.
And I know
It does. Right. We have those charts. We'll get to that in a second.
in July and say goodbye.
I want to make sure that we hit your RenMac econ market cycle chart. What are we? Trying to throw this up, please?
It's a clock.
Yeah,
We've
it's a
got
clock.
inflation and growth. What
It's
time?
actually a treasure map.
So what time is it? Please.
So it's 9:00, right? This is juxtaposing inflation.
Wait, what is
versus
this? I'm sorry,
growth.
Jeff. Tell everyone, what is this called?
This is our market cycle clock.
The
RenMac
market cycle clock.
right?
There's no TM there.
There's
you
a
guys should TM this
yeah,
thing.
we should.
Okay.
There's a relationship between inflation and growth. All right. There's a lot of different ways to measure both. It's proprietary how we do it, but it's not. It's all public information. We're not, coming up with something terribly outside the box here. We do the math. The transformation is a little unique in that we use some diffusion indices versus rate of changes, et cetera, because they tend to be echoey, and you don't want that.
We do the same thing.
Yeah, right. So
we concur.
well, COVID, right?
Wait.
What happened to COVID?
Wait, what do you mean diffusion? What are we
Better,
saying
good
here?
or bad?
Okay.
Good
All right.
or bad, better or worse, right?
Okay.
We care about are things better or worse?
Not the
Jeff,
number.
versus good or
He's
bad.
neither CFA
Correct.
nor CMT,
It's fine.
so
Yeah.
you have to dumb it down, please.
It's fine. No, it's fine.
Talk to me as if you would a small child
It's fine.
or a golden retriever. Okay.
I understand. The inflation has perked up. Those shadows that you see is where we were over the last 6 months, right? So we were down the bottom left-hand zone. The color, this is for you, Josh.
But you want to be there. You want to be in the bottom
there,
left.
Right, absolutely. We were there the entirety of 2023.
But is that why it's that dark colored green?
Yes,
that's
'cause
the
good things
best,
happen.
That's the best place to be.
Yes.
So now we're drifting. We're drifting
in
away
a
from that.
spot that's now historically more average returns. But here's
Okay.
the kicker. It's really unusual
Mm.
that this move clockwise. Usually it moves counterclockwise. In other words, when we're in the bottom left,
Oh,
we would
shit.
expect to go to the bottom middle,
This way.
right? And then start going higher, right? So we think, and Neil would
That's a reacceleration of inflation. That's why that happened.
right, but where Neil's coming down is these data points that we're seeing, the long-term data points would suggest that that rate of change, that inflation is going to continue to move in a favorable trajectory. And what we've really seen is kind of these random 4 or 5 indications that have popped, but they've had enough weight in the inflation prints to give us more than what's really underlying trend inflation.
Okay.
And so the idea here is this is a very unusual move. The only time that we did something like this before was when Saddam Hussein invaded Kuwait and we had the oil shock, right? So it was a spike in
it was exogenous. It was not
event.
economic.
Exactly.
Okay.
And so it was a supply shock. It spiked the inflation, and then we went right back into the clock.
So this is an unusual period that we're living through, obviously, with inflation falling, trend, and growth still doing reasonably well. Yesterday, Powell said, "I don't understand where concerns about stagflation are coming from. Stagflation in the 1970s was 10% unemployment, high single-digit inflation, slow growth. Now we have solid 3% growth and inflation under 3%. I don't see the stag or the inflation."
Right. I think that's totally fair.
I want to ask your opinion on John,
Stagflation, by the way, would be it wouldn't be there.
Put
It'd
the
be
clock,
in the top.
Put the clock back up.
and
I
it
have
would
one more
be
question on
in-
this.
It would be in the top left to top middle. That would be your high inflation, lousy growth,
Not where
middling
you wanna be.
growth. Not where we are.
So Jeff, the y-axis here is inflation. The x-axis here is S&P 500 annualized monthly return.
Who says he doesn't know what he's talking about?
And what we're saying here is where the hot dot is right now.
Yeah.
It's not in some sort of, for those who are listening, it's not in some sort of a danger zone. It just tends to lead to average returns. The box is white.
Correct.
Okay. So this is not something to be alarmed about. This is my question. If we continue to move clockwise, which you said does not happen very often,
Yeah.
and we get into that top left-hand corner, it's still a white box
Yeah.
where the average returns for stocks prevail. But
Yes.
that would be, if this is an aberration,
Yeah.
that would seem to be a huge aberration.
That'd be a big outsized event and probably almost impossible without
Hold
supply
on.
shock.
So almost impossible is a thing.
Yeah.
Could oil prices do it?
Sure, absolutely. I mean, that's usually the driver of inflation.
But so would you and Neil sit there and say, well, it's just oil prices? Or
No, that passes through. That's a big deal.
Okay, so
Yeah.
then you would say, okay, now the clock is a doomsday clock because it is continuing in the wrong direction.
It's in a bad spot, and your
Okay.
growth is slow. Yeah,
All right.
that's a bad outcome.
All
And
right.
by the way, that's white, and it's a low number. 2.74% is a low number. So why is it white? It's because it happens so few times. 41 is the number of instances that statistically it's too few to really. What is 200 basis points? How much confidence do we have in 240 basis points? Not enough to make that call.
So expectations, John Charlton, please. Expectations of a Fed cut increased yesterday during and after Powell was speaking. Are you surprised, for people that are listening, not watching, are you surprised that the expected basis points of total Fed cuts in 2024 drifted lower the entire year as the market seemed to really not give a shit at all? I mean, eventually it did, but maybe that was just noise when it pulled back as rates went higher. Were you surprised by the path of this juxtaposed with where the S&P went
And
all
what do you
year?
think? And what do you think of our chartsmanship?
Good God, I'm trying to digest what you just said. I got to get in Josh's crib here. Let me think about this.
So in 20,
That's a good chart.
but it's
We
Simple.
ignored all of these dwindling odds of cuts.
But in 2023, this was all that mattered, was the market was rallying heavily on expectations of a Fed cut.
Yeah,
That peaked, and
Yeah.
the market seemed to not give a crap. It kept going higher.
yeah. You already dropped the S-bomb, so you might as well say it again. I didn't know this is cable, first and foremost, but okay. Look, the amazing thing to me has been since basically a year ago. Well, it was before that. The forward curve, right? When you look at the forward expectations, the forward curve has continued to be wrong, right? The forward curve was, we've got 3 more months of hikes, and then we're going to get cuts.
Right.
And that has just not played itself out. And the market hasn't really cared one way or the other. Now, I think it got to an extreme back in October, right? And then it reversed, and that gave us, obviously the nice tailwind that we've seen over the last 6 months.
Right.
Now there's some concern that that's not going to happen, and so we were getting this correction, and that's taking place. I don't know how long that's going to go. Powell seems to intimate that he's not going to hike, but maybe he has to push this off a little further. But
Well,
again,
he took the hike off the table yesterday.
he took,
basically.
right, you're right. So that was something that was a concern that was out there that's going to affect that probability, right? The question is it 1, is it 2, is it 3 this year? How does that look? And that's all going to be inflation dependent, as he said. And if you look at Neil's work in how he's thinking about these data points, within 3 months, the alignment with Powell's testimony yesterday with the data should come to fruition. In other words, by the middle of the summer, we should be in a pretty good spot if those data points kind of go back to acting the way they should and not have this kind of random synchronicity that they had that really threw things off.
One thing that's been powering the market higher has been consumer spending, consumer resilience in the face of higher inflation. And it's pretty astounding to see that consumers are not changing their spending habits. But there is one area where it's starting to come to fruition, and that is where people are spending their money in terms of fast food. Pizza Hut is having some issues. Starbucks yesterday was an absolute abomination of a conference call. In fact, the CEO started with, and I'm quoting, thank you, Tiffany, and thank you all for joining us this afternoon. Let me be clear from the beginning. Our performance this quarter was disappointing and did not meet our expectations. Our Q2 total company revenue was $8.6 billion, down 1% year over year. Global comp store sales declined 4%, negative 11% comp growth in China. Our global operating margins contracted by 140 basis points, and our overall earnings per share declined by 7%. This is a wild opening statement, and you've probably seen this before. I never have. Where you see a gigantic gap on a monthly candlestick chart because it happened
At the beginning?
John, we have this chart. So
Does it happen on May
look
1st?
at this.
Yeah.
These are monthly candlesticks.
Yeah.
I've never seen this before. So this thing gapped down 17%.
Ugly.
Put up the 5-year price chart, John. From this is a Y charts. So I'm not showing you candlesticks. I'm just showing you price.
Nasty.
This looks like it's on the way toward the lows from the pandemic.
Oh, yeah.
That's crazy to
Yeah.
me. That's
Yeah.
really the Starbucks ended the day down 15.84% yesterday. This is the worst day for Starbucks since March 16th, 2020. It was down 16.2% on the day that the world came to an end.
Yeah.
So that's remarkable. Our research associate Sean tells me Wednesday ranks as Starbucks' 3rd worst day in public company history. Its actual worst day was July 1999, down 28%. Not sure what happened there. And again, minus 16% in March 2020. The CEO went on with Kramer. Kramer cooked him. He was on with David Faber, Carl Quintanilla, and Kramer. And it was like good cop, bad cop, worst cop. And Kramer just lit him up. And one of the things that he said, which is relevant to our discussion now, the CEO, the occasional customer, to Michael's point, he said he kept saying, I think he said it 50 times in 15 minutes, the occasional customer is visiting less. And then he also cited deterioration of economic conditions, which I'm not so sure about.
He cited weather.
Weather, geopolitics in the Middle East was an issue. So it's really bad. And Kramer's like, what if you just priced yourself out of the market for what people want to spend?
Well, they did. They did. So I am a Starbucks daily drinker. He said, despite strong mobile and order pay and sales, we saw a mid-teens % order in completion rate within the order channel this past quarter. In other words, they're putting items into their cart and they sometimes choose not to complete their order, citing long wait times. It's not wait times. It's so fucking expensive. I drink Starbucks.
It's a $9 coffee. It's
I just get the dark roast. That's it. I'm a very simple man. And I've started to say, you know what? I don't feel like spending $4 today. And I've started to make coffee at home, which I never did.
Nutmeg or no nutmeg? You put nutmeg on it?
Not a nutmeg. But it's just, it's too expensive. It's crazy.
Our question is, what is your order at Starbucks?
I'm a venti cappuccino, extra shot, whole milk,
Have you noted?
slightly wet.
So what are you spending? So you're $6.75.
Yeah, that's a $7. I don't know anything about
It's
that
seven-
other than
it's
that's
7+.
That sounds like it's 7
It's
handle.
too much.
I went from the devotee category to
Yeah.
the occasional category.
So,
Well,
so
you
And I brought in an espresso
I was-
machine, which is fantastic, by the way.
I was 365 days a year, and I'm probably down to 320, and I'm definitely not unique.
Now you're an occasional customer, so you're in that.
No,
bucket.
I'm still 85% of days, but
Is this a canary in the coal mine for consumer spending and therefore the entire
dude, it's
U.S.
a
economy?
it's a Starbucks
or is it
issue.
Starbucks
It's a Starbucks
specific?
issue.
What if you had to guess?
Look at Chipotle. Look at Domino's.
All right, look at McDonald's. They said
Look
the same.
at
They said
but
they
look
said
at
the same
Texas
thing.
Roadhouse.
Okay.
So I think at best that's a stretch. I think it's very idiosyncratic.
Well, there's
and-
companies on
and
this side
yeah.
that are able to raise prices and people keep going. Chipotle, a great example. And then there is McDonald's and Starbucks, and people are starting to say, you know what? Because at some point, with some of these foods, like if I'm going to spend $16 for this,
I want something good.
I'll either spend 20 or 25, or I'll just make it at home.
Yeah. So when we look at industry groups, we do it equal weight, so we eliminate the Amazon effect, right? Or
So
the
it's
McDonald's
consumer
effect.
discretionary.
Yeah. And when we go through for restaurants specifically, we'll look at the Russell 3 because that way we get a huge population, but they're all equal, right? So we'll get a huge population, and the restaurants in the Russell 3 are still in an uptrend. Restaurants in the Russell 1 are still in an
Wingstop. I know
uptrend.
it's just one stop, but
Texas Roadhouse.
but there are
Well, that doesn't. They have the lemon pepper. That doesn't count. Come on. I mean, come on. Fight fair. Fight
no.
fair.
So the point is, there are some restaurants that are killing it, and some are getting killed.
Shake Shack had unbelievable earnings yesterday. Reported.
Yeah, and Shake Shack's not cheap.
And the stock held up, and they don't sell cheap shit.
Yeah.
So I am a more than occasional visitor.
He's in the loyalty program. They don't even have a loyalty. They don't even have a loyalty
The
program.
royalty program, Holmes. All right, can we do Apple? This is the second largest publicly traded company on earth, right? Microsoft bigger now?
So
Okay.
I actually feel like for the first time
God,
in
I'm
a
glad you
while,
answered that because I would not have known what the bigger one was.
Microsoft's bigger.
Yeah, okay.
I'm pretty
Microsoft
sure.
is now they oscillate. Is that the right? am
I think
saying
that
right?
I think that Apple is marching to the beat of its own drum, and the market doesn't need it anymore.
Unless they see something, I think you're right. Unless they see something really horrific about the consumer,
True.
probably okay.
But I think that for the most part, the Apple story is actually an Apple story and less of an overall consumer story.
Here's the story on Apple. We're looking for literally negative 10% on iPhone revenue, which is half the company's revenue.
Yeah,
That
nobody's
is,
expecting anything.
that is not great.
Yeah.
Services should be up. It's the only growth business there.
Not a great chart, I'm going to tell you.
Not a
No.
great chart.
No.
Not a great chart. And I think Nvidia has been the primary beneficiary of money out of Apple. Like I think it's literally handing market cap, not market share, market cap
Understood.
to Nvidia.
Yep.
This is their fifth out of the last 6 quarters of sequential year-over-year revenue contraction. That's really rare.
Yeah.
And it's not even like selling at 16 times earnings. It's like a 28 times earnings story. So the market might not need Apple, but a really bad reaction in Apple is gonna, and we're
People
gonna
will
run
notice it.
We're
Yeah.
we're gonna run this show tomorrow, so I don't want to like go crazy on prediction, but I still think it's important.
Well, here's
Put the
so
chart up there. Can you put a chart up?
so
Yeah.
so the chart that I just made is Apple divided by Qs. This is weekly.
Yeah.
So it's stopped going down relative to the Qs over the last couple of weeks, but this could break hard tomorrow.
Yeah.
Or not, or it could bounce. Who knows?
I mean, I would think it would bounce from there, but not to change. Like
So that's
in
divided
our
by
view,
the Qs. That's just the Apple weekly.
yeah. The reason I asked you to pull it up because it's kind of fallen off our radar. I can tell you this: that the 50-day crossed through the 200-day about 3 weeks ago. Just as a very simple definition of trend, and so it went from tech is leading to. This is actually rolling over and looks vulnerable.
That's daily. Not looking good.
Yeah. So I would actually expect that to rally, and I'm a seller of the rally.
Tell you what else happened. We found out in the middle of February that Berkshire Hathaway had trimmed its Apple position in Q4 for the first time since they started to invest in it. That's their largest shareholder, and that was the buyer of basically every share that someone else sold.
Amazing.
Either was bought by the Qs, the company buyback, or Berkshire. And that dynamic is now not. I mean, maybe they started buying it again.
But I guess to your point, nobody is expecting much.
That's the good news. Yeah. And they also are probably not going to have a great number from China, which I think the expectation is it's like negative 14% China sales. And people are paying attention to that now because it's a really key market for them.
What always scares me about technology is the old saying that in the long run, every technology company makes toasters.
You would have thought that would have been true with this thing 10 years ago.
Well, it was true with BlackBerry. It was true with Motorola.
Yes.
It's like at some point, it's probably going to be true, right? Unless they catch up and they can somehow figure it out. And
the toaster companies never figured out services
or software.
Or software. I get it. There are differences.
I'm sure there will be a question.
I just worry about it becomes so ingrained in who we are and what we do.
Well, iPhone's not growing,
but and something else comes along.
Well, it's not the Vision Pro, at least not yet. I'm sure that'll come up, and it's just been an absolute bomb.
Can we look at your bullish call in December based on escape velocity, looking for 5,800 by year end?
Sure.
And then you have a thrust indicator confirmation here.
Right.
So tell us the story. What are you telling RenMac clients right now?
So there's two ways that we think about momentum. One is through trend, which is path of least resistance. Think about trend as I spilled this delicious margarita on the table, and somewhere it's going to end up.
Nicole will kill you.
Right? The path of least resistance, somewhere that margarita will end up on the floor.
Sure.
So that's the trend. Then we think about rate of change, and rate of change is momentum. How quickly, what's the velocity of this thing? And so if you don't have trend in a market, if you just wait for trend, the risk is, we all know it, the risk is that you're going to be late. Not that it's going to be completely wrong. It's just going to be you're not going to be as invested as quickly or selling as quickly as you might otherwise be able to. So momentum helps you bridge that gap and say, okay, look, between a bearish trend and a bull market, is there something I can do to get myself in a more favorable position? And momentum is one of those things that we find. So this is internal momentum. This is exactly what we talked about with the 20-day lows, except these are 20-day highs. Right.
Okay.
And so when we look at 20-day highs, again, that 50% number tends to be a good number. You can see our little green arrows. You can see the forward returns. Those forward returns are generally better than not. Now, there's a couple other stipulations we use with that. But the punchline here was we're coming off of an extreme sentiment condition in October. And all of a sudden, we punched 20-day highs into about 71%. That's obviously a huge number on this chart. But I'll tell you, in the last, 70 years, since 1957, that has only happened 70% or better 6 times.
Wow.
So it was a really, really unusual bullish example. The 3-month forward return, when we get
the 71% is the percentage of stocks making a 20-day high.
On the S&P.
In the S&P.
Correct.
Okay.
So the 3-month average returns, 0 times was the market down from that point, right? The day after, not including that day, right? At the close of that day. 0 times is the market down. 1 quarter out, the average return was 9%, which we got.
Yeah.
And this is essentially the end of the year, so it's close enough. 6-month returns were 14%, which we haven't seen yet, but that tells us there's still some dry powder left in this thing. and 12-month returns are 22%. Again, zero losses, right? So the average is 22%. So obviously some are a little higher, some are a little lower. But we looked at that along with the sentiment and just said, look, this is a pretty unusual number. We don't get this very often. And this is going to catch people off guard. So certainly for the first 6 months, we got to maintain this bullish stance. If things deteriorate or there's something that happens in between, we can reassess it. But between now and then, these numbers are just too powerful for us to ignore and say, well, I think it's, the Middle East or,
And
coming
this
up
was
with
you
some
at the
bullshit
beginning
excuses.
or at the end of last year?
This was officially December 14th of
Okay.
2023.
So let me ask you a question though. So I understand that and bread thrust, and there's a psychology behind that. Why all of a sudden is everyone, buying all these stocks that can't be bearish? I agree. But you also mentioned before that you look for mean reversion. This is not one of those things that you're looking for mean reversion in.
No.
Okay.
No.
Why?
Well, the history tells us that, right?
Okay.
And usually after you get this escape velocity or these thrusts, there's an element of time that develops before you end up with the reversionary factors being a problem. Now, we go back to that rolling alpha that I talked about. Right now in the rolling alpha, I don't know exactly where it is. I'd say it's probably in the 70th percentile. We worry when it gets in the 90th percentile. So it's not the reversionary factors that we concern ourselves with, which are long-term, by the way. They don't tend to be very, very short-term. They're just not in a position that's overly over concern.
Okay. I like that. And I think most people, when they see a bread thrust, they have one of two reactions. Either they don't notice it or even think too much about, why it's happening, which I think is probably most people. But then there are people that do notice it, and they're usually underinvested. Like for me, that's a signal for people to chase.
Absolutely. That's exactly right. But
it's like you're not in the game.
But what is people's reaction to that, which is usually it's up too much, it's overbought, so I'll wait for a pullback. And then guess what?
Never comes.
It never comes.
Let's do sell in May and go away is bullshit. Better to sell in July and say goodbye. I haven't heard that one before.
All right.
I've been around for a long time.
Boom.
And then there's some tie into presidential election years. Let's throw this one up. So you mentioned before that May normally is the bottom of the market for presidential election years. I have a lot of opinions about why I think this time will be different. So I think most people do. But walk us through this chart. This is a composite.
Yeah, so back to 1928, you got two lines here. The gray line is seasonality in every other year other than an election year, right?
Okay.
So the year after, the interim midterms, and the year before. And this is a 2-year chart, by the way, so you get kind of a sense as to what's going on. The red is just specifically election years. That yellow stain is the election week, right? So that's when the
Excellent choice of words. I might have said bar, but stain is
Stain
good.
is good.
So the red dot is where we are today. And you can see that typically we will continue to weaken into the Memorial Day holiday. But as people start chirping about sell in May and go away, that actually ends up in presidential years being the bottom. Now, a word of caution, statistics. This is obviously a fourth the sample size of what you'd have
It was
otherwise.
1928 to 2024, so that's 40 different election years, roughly, right? 40 different cycles in here.
25, right?
No, I don't know.
100 divided by 4.
Oh yeah, 25. Okay, all right. So we have 25 years that this is an amalgam of.
Yes, correct. So
It's not terrible.
It's not terrible, but you can still drive a mid-sized car through it. Right?
But it's
So-
interesting how different it is from every
correct,
other
and that's
year.
what really stands out is that this point right here.
Yeah.
I wouldn't tell you in
from the gray.
But,
Right. In
but
September,
they
it
end up
doesn't
in the
make any
same
difference.
spot, which is also equally as interesting.
correct, which means that we rip
Right.
in June, July, right, and that's the risk.
Let me ask you this: Does any individual year actually look like this?
that's a good question.
That's a good question. I don't.
Does
know.
any of the
Right.
25 instances? All right. I think this is one of those years that if it's going to be aberrant, it'll make sense in hindsight. Of course, this didn't look like a typical election year. There's a non-zero chance that we actually don't have an outcome to this election. So, I'm just saying, like, this is kind of where we are. Okay. I don't want to say more on that. We did China. Michael, what else? Should we do this?
Let's just run through
excessive negative returns in China?
Yeah, let's do some of these charts. We spoke about this earlier, so we could just rip through these quickly. But these are too good to pass up.
Yeah, I agree. Okay.
So, all right. First one is the Shanghai Shenzhen 300. What are we looking at here, Jeff?
Well, that's a downtrend, right? But it looks like it's changing that
Seeing
trend.
crossover.
You
I'm
can
seeing
see,
crossover.
right?
Yeah.
And now, what I want you to point, what I want to point out is, look at that off the low, right? Look at that just almost straight up, right through the 50-day, which is that red line.
Like it wasn't even there.
Like it wasn't even there, right?
You know what? I'm going to wait for a pullback.
Now,
You know what this chart is? This chart is saying that the yuan is going to be the world's new reserve currency by the end of this year, as we devolve into civil war and chaos. I don't know. I mean, this is like this is a remarkable move.
it's a good move, but that's what we call an acceleration wall. That's why momentum is important, right?
Yeah.
Because if we're waiting for the 50-day cross to the 200-day, we're still waiting, right? But we have momentum. It gives us an early peak that the high probability of a trend change is
That's the bottom pane. That's your proprietary oscillator.
Yeah. It
But you
just
know what?
measures deviations from trend.
But you know why this is so hard? Clearly, just by the naked eyeball, and it's a very sophisticated naked eyeball, this looks like a trend change, but the downtrend is so powerful. Like, would you be
That's
that
a good
surprised if
question,
it rolls
'cause
over?
It looks like there was a fake out in 22.
In 22, yeah, but we didn't have the negative alpha, right? So you've got
Okay.
the setup, which is you just had this relentless pounding of negative returns. And so for every quarter, every year that goes on, when you get these thrusts, again, we could be wrong, but we'll be wrong by this much. And if we're
What
right,
is the
we're right by a ton.
What does the
300.
Shenzhen 300 look like? Sector wise? Who knows? Not important.
I mean,
30%
it is, but
Spartans.
I don't know it all.
John, next
You know,
chart.
somebody was just asking me. I was just in a meeting before, and somebody asked me. They said, "Look, we get what you're saying. China important. How should I play it?" I'm like, "What do you mean? How should I play it? What sector should I own?" I'm like, "All right, first and foremost, let's do this."
Buy the index.
Right. When you get a raging bull coming off a low, don't dick around trying to figure out what you're.
You know
like,
why
just
I think
own
that's
it.
so smart? Because whatever is the leadership group is going to become the largest.
Correct.
It's going to become the largest weighting in the index anyway.
Correct.
So
The
why get
only
cute?
The only thing that we found consistently, if it's a new bull phase, is beta. That's it. So sometimes beta's energy, sometimes it's not. Sometimes beta's tech, sometimes it's not. Just make sure you have beta. That's really what you want.
So to your point about this just being the negative excess returns in China, this looks nothing like the previous other failed breakouts.
Correct.
Like it's just the downward movement. And for the audience, Jeff, what are we looking at?
So the bottom pane is, what's the best way to put this? This is looking at the amount of return I'm getting per unit of risk versus the MSCI World Index.
It's literally off the charts.
It's literally off the charts to the downside,
Oof.
right? So, I mean,
So you're
this is
getting
the
all
point.
the volatility that you would get from every other stock market,
And the
but literally
terrible
never
returns.
making money from it.
Right,
So then at this point, you married this with sentiment, which we'll get to in a second. You just have to say, all right, just hold your nose and buy something.
That's what that is. Yeah, this is the you hold your nose.
Any other charts in the world that look like this?
Some healthcare charts in the U.S.
Like
Pfizer did.
Biotech,
pharmaceutical.
Bristol Myers.
life science tools.
I'm kind of bullish on that idea too.
Yeah.
So I think the Biden administration, there was just a ton of fear about drug prices and what the government was going to come in and do. He might not be the president in 3 months or 6 months or whatever. Like, I think there's some really great setups there. So I agree. What else? Anything else?
I would just say on the other side of the ledger, home builders are actually excessively bullish returns to the point, and I don't want to marry this because it's not going to be the same, but the return profile, risk-adjusted return profile of the home builders is almost exactly where it was in 2005.
Interesting. Very interesting. Okay.
So-
I love it. What's the next one? You want to do the ETF outflows?
All right, lastly.
So this is a sentiment setup, right?
Yeah.
So this is for the
This is
CQQQ.
people pulling money out of, what are the big China ETFs besides KWeb?
FXI.
This is
FXI.
CQQQ.
Oh,
This is
CQQQ. Okay.
the tech one, right? So
Right.
it just shows that people had essentially said, "Why
Can't
am I?
take it.
Why do I own these when Nvidia is going up every day?"
Well, these
3
are
or 4%?
these are allocators answering to clients, and it's like absurd. Why?
perfect.
How
Yeah.
long could you go
Yeah.
on defending this
Right.
theme?
right.
Right.
Okay, I love it. I love that.
Yeah, at
idea.
some point the client says, dude, I've heard this
Yeah.
enough.
and
Right.
don't care.
Right.
Stop saying the same thing.
I'm tired of your conviction.
Right.
Put up the John, can we
Right.
get the metals chart up? So there is a correlation between China and metals. It's like one of those things that I hate Dr. Copper. We're not going to do that, but like it really matters a lot for the metals, right?
Pay attention to it.
Okay, so what's going on here?
Specifically, the red line is the relationship, the relative performance of copper versus gold, right? So the idea is, are industrial metals outperforming monetary metals?
JC does a lot of
loves
work
this
on
chart.
this. Yeah,
So this is moving higher. You'd want to see this confirming with a movement in China. It is. So it just gives us a little more comfort that what's happening in China isn't just an aberration, but it has some fundamental discipline to it.
But Jeff, is there a chance that this is the tail wagging the dog and people see Chinese stocks rally and they reach for the more leveraged way to play it, which is copper?
Maybe, but I don't know if you have all the charts in here, but it's happening in aluminum. It's happening in gold.
Okay, so it's too broad.
It's too broad for that to be, manipulated.
I would buy that correlation. That makes sense to me. Yen depreciation drawing attention. Yeah, I saw people chirping about this.
I mean, this is as long as I've been in the business.
It's Japan. Japan.
unbelievable.
All they ever do is intervention. Why is this a story now? Do you think?
Well, because you've got yield curve control, right? So now they have to kind of they have to decide: are they willing to let the tightness be reflected, the normalization of the yield curve be reflected in the currency, which chokes off the recovery, or do they want to keep the currency in a competitive landscape without being?
They have positive real yields on JGBs now, or close.
I think it's right there. Yeah,
okay,
I haven't looked.
And they have a stock market at 33-year highs.
Yeah.
So what is this about from their perspective?
It's a good question. I'm not exactly sure what the angst is, but I mean it's a bad chart.
Does this look like a reversal to you, or way too soon to tell?
That's a bounce and a downtrend.
Yeah.
So when that gets overbought, that's absolutely
USD?
sellable.
Yeah.
Okay. I mean, you've got a lot of work to do to take that and reverse that trend.
Seriously.
All right. So you guys in late February. So you mentioned like the momentum names just got too hot.
Yeah.
Like the stove is now burning whatever you put on the.
Not only that, but you had the momentum differential, right? The high momentum names versus low momentum names. That differential was extreme. But you also, in the option market, started to see that the pricing of upside was higher to get to capture the upside than it was to protect the downside.
That's backwards.
I remember reading this note and not fully understanding the chart that you included in it. So maybe I can ask you why I got confused. This is the Russell 1000 momentum Q1 through Q5 performance. These are quartiles within the Russell, or
so you take the top 200 names, right,
Okay.
that are the best performers over the last 12 months.
Okay.
You take the worst 200 names and you just pair them off against each other.
Okay.
And that
So-
spread, because that spread was about 14%.
So that's the thing that you're saying was extreme.
At the
best
bottom.
200 versus the worst 200.
Correct. Yep.
Okay.
Yep.
So why is that important to you?
Because at those extremes, it usually means that people have crowded into momentum, and that's the point where it's unsustainable.
Okay, got it. So where are we now?
So we went
since
from the
corrected.
96th percentile to the 81st percentile. Historically, you will take it at least back to the 50th percentile. You
When
have to go to the
get-
10th.
So when you
but-
do see that in the 50th percentile, is that your signal on a contrarian basis to say, I'm interested in momentum again?
No, not
And-
yet. It just
Okay,
says,
that's not what that means.
No, it just says it's just not. The factor excesses have gone away, and it's probably moved on to something else. Quality. I think it moves on to beta, but that's a.
Do you follow any of the momentum stock ETFs? Are any of those meaningful to your work?
I don't follow
Okay.
them
But
because
so-
everybody has a different definition.
When
so
the momentum wanes like this and it goes from the 90th to the 50th or whatever it is,
Yeah.
are those no longer momentum stocks? Like, don't they get reset?
we do it every quarter, so
Okay.
yeah, they can reset. But really, what you're seeing is, and I think that's one of the reasons that you're seeing this recent pickup in utilities, this recent pickup in staples, is that they were in the bottom 20%, right? So as the high flyers correct, the Caterpillars that you showed and the Nvidias, you've had Duke Energy breakout, you've had some of these other Procter and Gamble's broken out. Right?
We have
Some of these things-
we have
3M breaking out.
We have consumer state. So we keep our own list of like the best stocks in the market, predominantly based on how they're acting. They're all fundamentally good.
Yep.
There's 24 left on the list, and I think half of them are utilities and staples.
Jeff,
So
you'll
to your
laugh.
point,
Such just another of my trading hilarious stories. So I bought XLU right near the bottom when it was
Yeah.
getting puked, and the spread
Yeah.
between XLU and SPY was at an extreme.
Right.
And I got annoyed and frustrated, and I sold it right over there.
Yeah.
Whoops.
You want him to put a
We
Band-Aid on that?
we
boo-boo?
got
I don't know what do you want him to do with
my
that.
situation.
Laugh,
Yeah,
we're
you
laughing,
know what?
we're laughing.
Yeah, you saw.
You know what
Yeah.
works? Tequila works to kill that.
we
Hey,
go.
semiconductors, another call that you got right. In early March of 24, you cited the momentum excess there.
Yeah.
AMD reported this week, and I don't want to say blew up, but negative reaction. We've seen Intel have a rough time. We went from a situation where every name in the SMH was up huge.
Yeah.
Now it's gotten more selective. Do you think that'll continue?
I absolutely think it'll continue.
Let's take a look at this.
This is the excess returns. The exact same thing I showed you with China.
Yeah.
This is just for semiconductors, right? This is, there's an old saying, price to perfection. This is quantifying that, right? All we're doing, instead of somebody just shooting the breeze and saying it, we're putting this to numbers. And what this is saying is, look, if you believe trees grow to the sky, then no problem. This is going to work, right? But the idea is that once you're up here, what you're really asking is that your every unit of return per unit of risk is going to continue at this torrid pace, and we just don't see it that way.
It never happens.
It never happens.
Nothing can be as perfect as the semiconductor trade had been for a very long time.
And I think what's important, Josh, is that's not a repudiation of AI. That's not how that's going to change the world. That none of that has anything to do with this, right?
Right.
This has to do with people looking at that narrative and extrapolating it into the ionosphere.
So
And
let me
it just
redeem
doesn't-
myself. I sold AMD 185 at the way
All
up.
right, there we are.
Let it go on
There
the
we
way
are.
up.
There
Let
you
it go.
go.
It was too steep.
Semis and semiconductor equipment option score. What's in here?
So that's exactly what we're
reflecting
talking
the
about.
same thing.
Yes, that's when we're talking about the upside being priced versus the downside. That's the extreme. So
Okay.
you want both the momentum and the extremes in the pricing.
All right, let's do this last chart. We'll do NVIDIA. How bullish are you? No, I'm kidding. This is like, in my view, what NVIDIA has undergone in the last 3 years is probably one of the most magnificent stories ever for growth stocks. So it says nothing about where the stock's going to go from here, but just like we really have not had a lot of NVIDIAs throughout the course of stock market history. It's a really special and unique situation. A lot of things make it that unique and that special. I do think that there got to a point in February, March, where if you were a professional money manager and you called yourself a growth manager and you didn't have an allocation to NVIDIA, you look like an insane person, basically.
Yeah.
It's like career risk times 10 on something like this. Because not only was it such an amazing performer, it became the 5th largest stock in the country.
Right.
So not owning it was not just underweighting it, but really putting your career in jeopardy.
You're fighting the trend.
Okay, so that's probably what drove the rest of the semiconductors, quite frankly.
Sure, absolutely.
Okay. Where are we now?
Well, so this is, I put this up because this is specifically that option score that we talked about, right? So those red arrows are pointing. Look, it happened back in July of 23 too, right?
Yes.
So this is the point where the option pricing is more aggressive for upside exposure than it is to downside exposure.
So people buying calls are paying higher and higher premiums.
They're worried about the upside. They're worried about missing the upside.
They're worried about not catching the upside, right? So let's say the stock is at 100. I can buy a call at 120, right? I can buy a call for $5. That same put at $80, so same delta spread away, is at say $10. So the cost of insurance is lower than the cost of capturing the upside.
That's crazy.
It's crazy.
Yeah.
Right? Doesn't feel crazy at the time.
And that's like the bell.
And that's the bell.
Yeah.
That's to us where we just say, look. Now, again, if we look 12 months out, I can't tell you that it's worse or better. It's about the same. If I look 3 months out, it is definitively worse. If I look out 6 months, it's kind of, So what you do, in our view, you wait for, when you have that, you take that back to either, at best, you take it back to a market weight, but you probably underweight it. There are different option strategies you can employ to try to capture that differential. You wait for an oversold condition to develop, and you use that because it's still within an uptrend to say, okay, this is my chance to now step into this because it's still within trend. We've burned off some of the success sentiment. I still want to own the stock. This is my opportunity.
There is a universe where this stock has to be 1,000 just because it feels like it's a magnet pulling it there. And that's not extreme. It's an $850 stock. $85 stocks go to 100 all the time.
Yeah.
And if this had done a 10-to-1 split, and we're trading at 885 right now, nobody would seriously say it can't get to 100.
Right.
But for some reason, 1,000 both seems like it's a magnet, but also seems like it's going to be a ceiling.
Yeah.
So I don't know.
Supermicro did the same thing, right?
Yes. So I don't really know what to do with this, but I know it's the most vexing stock in the market right now, both for bulls and for bears.
So you're closer to the oversold condition, which was a buy. That was maybe a week ago. We think it's still in trend, so that's the good news. If you're a long-term holder, I think you're still fine. I would worry, and I would actually take action and reduce the positions if you broke under the low that we had, whatever that was 2 weeks ago. So
what was that?
I can't remember the
Was
total,
it
the number.
820?
Yeah, it's probably.
It was
I don't think it had a
750.
Was it 750? Okay.
Oh, it got that low?
Yeah.
What was that? Was that?
Intraday.
Oh, I was on vacation.
That was because Taiwan Semi. Did they warn or
I'm glad I didn't notice.
Yeah.
But it didn't last. It was there for a day.
No, it was rolling over. Then that hard break, and then it immediately recovered.
So that hard break
So-
was one of those days where 20-day low spiked.
Nvidia recaptured. I'm just eyeballing 50% of the loss. So
Yeah.
we'll
Is
see.
that the individual stock chart people ask you the most about, or Tesla?
Oh, Nvidia,
Nvidia more so than Tesla.
definitely.
I think they probably know what you're going to say on Tesla. Which
Yeah,
is-
I think
it's
that's
in
probably
it's in
true.
no man's land.
That's probably fair.
Right.
Yeah.
Okay. So
But
Nvidia,
we've also been talking about Nvidia, right? So we were cautious
Yeah.
on it 3 months ago. So now they're kind of like, "What have you done for me lately? Where are we? How do we think about that?"
So Jeff, you've been really right on a lot of key things in this market. What is something that we didn't ask you about that you think is going to be important in the second half of this year?
No doubt about it. And I've not been as sharp on yields.
Okay.
I would have expected yields to be flat, not up, flat to down, frankly.
What, like 10-year?
10-year yields,
Okay.
yeah. If we break through 5%, our bullish leanings are not going to be great.
That's going to change your opinion on stocks.
The market will change our opinion on it.
Sure.
Right? The market will do it itself. But I think the risk where we are right now, when we look at our yield impact model, when we look at some of the things that historically would be a detriment, because keep in mind, the 10-year yield drives valuation too, right?
Yes.
So the higher that goes, the more the valuation pinch starts to hit.
Why
the
is
equity markets.
5% the number? Because
That's
it's a
the old
big,
high.
fat round number.
It was the old high.
That's it.
Yeah, that's it.
What do you mean the old high from 18?
Yeah, from
November.
from
Oh, the
October.
recent old high.
Yeah.
No, it's not getting to 5%.
yeah. I don't think it is either.
Famous last words.
Wait,
I
why
don't
not?
think it is either. But
Well, I'm
Okay.
old enough to remember when 3% was going to be the trigger.
I'm half kidding. It just, first of all, it looks like it looks technically like a top. You know better than I, Jeff. But based on Powell's testimony yesterday, the risk that they're going to do another hike, it's over. You would have to see a significant upside surprise in inflation, and I think that's unlikely.
But if you have the risk to that is that if you don't take care of inflation soon enough, and I'm with you, I agree with that. But if you don't take care of inflation quickly enough, and growth is strong enough, then you can support those higher yields, right? That's the risk. They're walking a very, very fine line here because you want to push yields to the point where you actually break that lower, but you don't want to push us into recession. Right? So you want to break that lower that then allows you, right? You take the yields to 4%, but that allows you to cut rates by 150 basis points on the short end, and then you normalize the curve and things are back to
It's like money in the bank for the Fed.
Yes.
Okay.
So when I give opinions, I'm a betting man. So I like to sort of quantify where
Sure.
I'm at. I don't think the 10 years going to 5%. If I needed odds, I'm making this up. If I needed odds, like what would it take to get me to bet on 5%? I'd say like plus 275, something like that. Does that sound about fair?
From the guy with the Knicks shirt on, sure.
Sounds about fair?
Yeah.
Sounds about fair?
Yeah, that sounds about
Not saying
right.
it can't happen, but
I'm with you.
Yeah.
Jeff DeGraaf, ladies and gentlemen. Did you have fun
everybody.
on the show?
It was great. Thank you very much.
Why haven't you been back all this time? Is it my fault?
we were
Yeah, I
invited.
think it was your fault.
All right, dude. We can't let this length of time lapse in between your appearances. You're too informative for us.
I'll come for Cinco de Mayo, and
Well, I
I'll
wanna
come
ask
back
you
for
about
the holiday. Your Christmas fair across the street.
Who made the marks? You or Eric?
Eric, by
Okay.
pouring in the 1800 margarita mix into the cooler that we bought at CVS in aisle 9.
Okay. Wait, what's the tequila in here?
1800.
Oh, this is 1800.
It's good.
Where did the mix come from? It's like powdered mix.
No.
The 1800 mix.
Oh, like the bottle.
Yeah, correct.
Well, it's delicious.
Straight from Mexico.
Listen,
Straight from Mexico.
it's getting the job done. This is what's important. Let's do favorites. You got music for us? What do you got? You.
Me? What are
yeah,
you talking
I have
about?
something here.
Go ahead.
No, you.
The favorites. Yeah,
Your
you
favorite.
asked about my books or whatever, and I said, the one that really jumped out to me this week was Fried Chicken and Evil Women.
That sounds like it's a country song. Do I
I
have
think
that
it
right?
is. It's not going to win any Grammys, but I think the title should.
Whose song is that?
I don't even know. I just saw it, and I'm like, that is one of the best titles I've ever
Oh,
seen.
who's the country? Are you a country music guy?
I have to say I am.
That's a yes.
I saw.
So am I.
I saw. What's his name? Luke Bryan.
Yeah.
No, Zach Bryan. Which
Zach,
was it? Zach.
Zach Bryan.
In Long
played,
Island, like 2 weeks ago or whatever.
He played UBS.
Yeah, but then he also played the old Coliseum.
Oh, he did?
Yeah.
Okay.
It was one of the best
Who
shows
else
I've ever
was Tyler
seen.
Childers on that?
No, he was not on that show.
Who else was on
I
that
just
bill?
saw him in Tennessee.
Okay.
I saw him with Winchester, 49 Winchester.
Okay.
Fantastic. They were an opening act. They will not be an opening act for long.
Oh, really?
They are very good.
Okay.
49 Winchester. Mark
So-
my words.
So did you hear the country song that remakes the rap song Tipsy? Did you
have not
hear
heard
that
it.
yet?
No.
That's like one of the top songs on the country charts
Is
right
that
now.
right?
I think it might be the only case ever of country artists doing a remake of a rap song, but it's like pretty good. I don't hate it. I thought I would hate it, but it's not bad.
All right. So when you get home,
Okay,
or if
Dad.
you have it here, Gin and Juice
Yeah.
by the Gourds.
Oh yeah, I've heard that.
Yeah.
I've heard that.
Okay, that's a good. That's a good callback.
Yeah. Unbelievable.
This
My-
song title reminds me of Fried Neck Bones and Some Home Fries by Santana.
All
It was
right.
a really good song.
Yeah.
I don't know
There
that
we go.
one.
I bet the song is better than this song, but
Is Fried Chicken and Evil Women about exactly what you think it's about?
I just caught the chorus and I really couldn't catch
All
the
right.
rest of it. but
Adding
it
to
was
Spotify.
so
Michael, you
good.
got a favorite for us?
I rewatched for the first time since I saw it originally 10 years ago. John Wick on
How
the
is that a
airplane.
10-year-old movie already?
That's what it goes fast.
That's wild.
10 years old.
I can honestly
Unbelievable
say
movie.
Never
my
saw
neighbor, my neighbors are like ready to kill me. They're like, "What do you mean you've never watched a John Wick movie?" I'm like, I
How did you escape it?
don't know.
'Cause there's
Wait,
been like
have,
four-
you
there's
said
been
me
four of
either?
them.
You've never seen it either?
Of course I have.
I
No,
thought-
I've never seen
It's
it.
phenomenal.
And I've heard great things, and I have no idea how I've not seen it.
What did you pick up this time that you forgot it from the first time you saw it?
Well, I'm sorry you asked that because I was working while I was watching it, so it was background. It was background movie.
All right,
But-
but you loved it having it in the background.
Loved it.
Okay, if you want to watch something in the foreground, I'm going to recommend Ripley on Netflix. It's black and white,
All right.
classy.
Yeah, right.
Did you see the movie The Talented Mr. Ripley?
Of course.
Okay,
yeah.
how good was that movie, by the way?
Fantastic.
Okay, that
Even
thing
Philip Seymour Hoffman, come
So
on,
good.
right?
holds up.
Right?
He steals the movie. He
Yeah.
eats up every scene he's in.
Yep.
Gwyneth Paltrow,
Yep.
Matt Damon. So this is that was based on a book. They went back to the book as source material. So this is not a remake of the movie. They made a television series for Netflix just now where they go back to the book
Mm.
and they flesh it out a little bit more. And so it's like, I think it's 8 episodes
Yeah.
and it's incredible. You could tell they shot on location.
Bite
in
size. That's what I call
Amalfi
the episodes.
Coast.
Yeah.
Yeah. The scenery is amazing. The cinematography is amazing. Did you watch it yet?
I'm one episode in.
What
I'm
do you
liking it.
It's pretty cool, right?
Yeah, I like it.
Why does it seem like it's so special the way it was shot? What is it about that?
Well, I think it's Ellsworth, a famous cinematographer who has done a lot of beautiful films.
Why do you think they chose to film it in black and white? Because it takes place in the 50s and they wanted to.
A noir kind of feel, I think.
Oh, it's a film noir feel.
Yeah.
Okay. I think it's going to get really good. I'm in episode 3, but it's like the pace is speeding up as you go. It's like one of those shows.
Is the actor or the cast anybody you know?
Who's in the show? Nobody. They're all unknowns.
Yeah, I don't know the lead.
You know what? You know why that's smart? Because how do you recast that? The movie was flawless.
That's true. That's a good point.
So what? Like you're going to put 3 new movie stars in it?
Do you have the same?
It's
Is the Philip Seymour Hoffman character
It's
there?
nothing like him.
Okay.
Yes, he's in it.
Yeah.
But it's again, they didn't remake the movie. They went back to the book.
Got it.
So whatever the artistic choices were behind the movie were thrown out, and it's like somebody starting fresh with the original source material.
Yeah.
And it's I think it's really well done, and I like that it's not somebody trying to be Matt Damon.
That'd be hard to do.
Pretty
right?
damn hard
when
to do.
But you see a movie, right? A good
Yes.
movie, and then you read the source material where they clearly took artistic license.
Yes.
Now you're making another film, or not a film, but a series.
Yeah.
That doesn't want to replicate the movie, but it's coming from the same source material.
It's really
But
hard.
you want it to be good.
But you have to let a lot of time pass. Because
fair.
let's face it, like Jude Law is one of one. Matt Damon is one of one. Like you're not gonna get an actor who does their best Jude Law impression.
Right.
So that I like the choices they made with this. If you've never seen that movie, you'll enjoy this. And if you saw the movie last week, you'll still enjoy this.
Nice.
So I thought this was very well done. So everyone check out Ripley. Okay, that's it from us this week. I want to thank everybody that joined us in LA once again. When are we going to have that out? Do we know? Did we put a time on that? Go ahead. Monday. Okay, that's great.
I think we're breaking it into two though. Just so we'll have to see how it comes together in post. We'll do it in post.
Because we had two guests on it.
Bellany first, time sensitive.
Yeah, we'll see. Yeah,
you guys will figure that out. All right. So shout to the listeners and the viewers. Thank you guys for checking us out all week. Special thanks to Jeff deGraaf of RenMac. Where can people learn more about Renaissance Macro?
Well, you can follow us on Twitter, which is RenMac LLC or at RenMac LLC. You can go to our website, and we have a podcast every Friday, which you can pick up on the Twitter account as well.
Podcast listeners, listen to the RenMac podcast. The newsletter is go.renmac.com/newsletter. So if you want more insights from Jeff and the gang, that's where you're going to get them from. We appreciate all your amazing charts and all your time today. Thank you so much for coming by and hanging with us.
Guys, always fun. Thank you for having me.
All right. Take us out.